Welcome to this special edition of CBA's Talking Economics with the Commonwealth Bank of Australia's Chief Economist, Stephen Halmarick. Now, Stephen and a team have been travelling around Australia as part of a national roadshow, talking to clients and giving them an update on the global and Australia outlook for 2023. Market volatility and changing economic conditions have been top of mind, so I'll hand over now to Stephen to talk us through his views. Stephen.
Thanks, Tony. Great to be with you again, and really pleased to be able to share our views with all our clients. The pace of global economic growth is expected to be slower this year than last year. We're forecasting just over 2% for the global economy. Last year was 2.7%. And the real reason behind that slower growth is the big increase in interest rates that's been put through by almost all of the major central banks. And that's on the back of this big increase in inflation. So inflation's risen right across the advanced economies, very similar, very high inflation rates across all the major economies. That's really a flow-on of the extensive monetary and fiscal policy easing that was put in place through the COVID period to get the economy through those very difficult times. Central banks are now doing what they only know to do, which is raise interest rates very aggressively to try and reduce demand to get on top of this inflation problem. But we do think, particularly in the US, that we're nearing the end of the rate hike cycle. The US Federal Reserve has suggested there's only one more rate hike to go. We think that'll be at the early May meeting. So we're nearly at the end of rate hike cycle in the US, although some other central banks still have a little bit further to go. Now, one of the key developments in recent weeks, of course, has been some big concerns around the global banking system, especially in the US, but also in Europe. So we've seen the US authorities act very aggressively to try and cut off risk of contagion of concerns in the banking system. And of course in Switzerland, we've seen what you might call our forced mega merger between some very large investment banks in Switzerland. But this concern of the global banking system has created a significant amount of volatility in global markets, seen a big decline in bond yields as market participants price out any further rate hikes from the major central banks. So this period of uncertainty and volatility is likely to last for quite a while longer, although we do think that the central banks, the regulatory authorities, both in the US and Europe, have the tools to ensure that there's not significant contagion across the financial system. The other factor that's going to continue to dominate the global economy is global supply chain. But the New York Federal Reserve publishes an index that measures global supply chain pressures, and that index has shown quite a significant improvement in recent months in global supply chain, really around the reopening of China after the COVID zero policies. So after a very difficult period through COVID, and then when Russia invaded Ukraine, global supply chains now do look like they're improving and getting back to a more normal setting. On the back of that, we've seen some of the key commodity prices move lower in recent months, things like energy and resources and some food prices. So that combination of a better global supply chain, some decline in commodity prices off their very high levels, is expected to help the global inflation momentum continue to slow. So inflation's still too high, but it looks like we are past the peak and moving lower in some of the key economies, and we think that's going to include Australia as well. Another factor that's going to continue to dominate the global economy this year and beyond, of course, is policies designed to help the world move to a net zero carbon emission by 2050. So this is a significant transition for the global economy, producing every unit of GDP with less carbon. That's going to require a significant amount of capital expenditure around the world. Now we can see from these charts that fortunately here in Australia, we already are seeing quite a significant increase in the amount of capital, in lending, in bond issuance, going into the ESG sector, the environmental, social and governance sector. At Commonwealth Bank, we talk a lot about banking the transition, and it's really pleasing to see the capital beginning to flow to the areas of the economy that are going to be required to help us move to that net zero by 2050 goal. So we think this will continue to be a significant influence on the economy this year and beyond. And in the Commonwealth Bank research team, we're now devoting considerable resources to what we call sustainable economics, writing research on all the areas that impact the transition to net zero for the Australian economy and the global economy. So now we'll turn to talk specifically about Australia. Now we are expecting a considerable slowdown in the pace of economic growth this year, calendar 2023, down to 1.5%, and that comes after a very strong 2022, where the economy grew by 3.7%. What we could see through the data was, as we were allowed out of our COVID lockdowns, Australian consumers had a lot of cash at hand, a big increase in savings, a big increase in income, and the spending in the economy was really quite strong, and that really helped drive economic growth through calendar 2022. And the best place to see that really strong momentum in the economy last year was the labour market. The unemployment rate dropped to a low of 3.4% in the second half of last year. That was the lowest unemployment rate since 1974. But as I mentioned, through the course of this year, we are expecting the pace of growth to slow significantly as the big increase in interest rates flows through the economy, particularly the housing market and the consumer. And we do expect the unemployment rate to drift higher to around 4.25% by the end of this year. So thinking about the labour market more specifically, as I mentioned, the unemployment rate dropped to almost 50-year lows. We saw a big increase in the participation rate, the number of people joining the labour market, and a big increase in the employment to population ratio. So by any measure, the labour market was very strong. We did see some weakness in employment in December and January this year, but that was more than offset by another relatively strong report for February, with the unemployment rate at 3.5%. But there are some early signs of some softening in the labour market. The number of job ads out there, the number of job vacancies is beginning to turn. So as we go through 2023, as I mentioned, we are expecting some softness in the labour market, with the unemployment rate back to around 4.25% by the end of this year. So that's up from the current 3.5%, but still well below the pre-COVID levels, which were a little bit over 5%. Now, one of the factors that really helped drive the economy through 2022 was an increase in income growth. So this came on the back of more people being employed and a pickup in wages growth. Now, we could see through our internally generated Commonwealth Bank data that income being deposited into Commonwealth Bank bank accounts was very strong actually through COVID. And we could see that the government benefits more than offset the loss of wages and salaries. So Australians as a whole were earning more income through COVID thanks to those generous government benefits. The savings ratio increased from around 5% to over 20%, the share of our income that we save every month. And that saw a big accumulation of savings inside Commonwealth Bank deposit accounts and offset accounts. Now the savings ratio has now declined back down to under 5%, so it's lower than where it was pre-COVID, but still we can see there's been a big build-up of money sitting inside people's bank accounts. Now that money is essentially a transfer from the Commonwealth Government balance sheet to the households. So the Commonwealth budget deficit increased from around about $0 to $200 billion back to zero through that COVID period. But it's very instructive to look at not just the increase in nominal income, but the increase in what we call real disposable income. So this is income after we take account of the big increase in inflation, higher taxes being paid, and the increase in debt interest costs. So after we take account of inflation, taxes and debt costs, real disposable income is actually weakening. So on an individual level, many people will feel like their disposable income is lower than it was a few years ago. And that's what really is going to be impacting, we think, the consumer. Now, in addition to higher interest costs, we're also seeing higher rent costs. So around a third of Australians are going to be impacted by the higher mortgage interest repayments, and another third of Australians impacted by higher rent repayments. So real disposable income weakening, and we think that's going to have a big impact on the consumer as we go through this year. So one of the big advantages for us here at Commonwealth Bank is we have access to the spending on CBA Credit and Debit cards. Every week we get a very large data set on spending on CBA Credit and Debit cards. All the data is anonymised and aggregated, so we can't see individual people, but it gives us a great snapshot of spending in the economy. Now, what we could see is that through the first half of 2022, spending on cards was very strong, lots of momentum. Then as the Reserve Bank started raising interest rates, spending growth weakened. And then in January, it was quite strong again. So many people took holidays in January, really the first time in 2 or 3 years where they could take a holiday. So the first 3 weeks in January in particular, spending was quite strong. But through the end of January, through February, into early March, we can see clear signs of a slowing in the momentum of spending by the consumer using their CBA credit and debit cards. And that makes a lot of sense given the increase of interest rates we've seen over that time, higher prices, and the consumer really having to adjust to this decline in real disposable income that I mentioned previously. So we think we'll continue to see a moderation in consumer spending over the course of this year, and that'll be the primary reason why economic growth for Australia is much softer this year than it was in the last year. So when we think about inflation, the December quarter 2022 inflation numbers showed quite a significant increase in inflation in Australia. The headline rate is at 7.8%, the underlying inflation rate 6.9%, so well above the Reserve Bank's 2 to 3% target range. But there are some good signs, and we're relatively confident that we've seen the peak in inflation. We think inflation will be lower throughout the course of this year. By the end of 2023, we think inflation will be around 3.5%, and then by middle of 2024, back to the 2 to 3% target range. So we have seen this big increase in inflation, but as I mentioned, the signs are pretty good. We look at the trim mean has begun to decline, the trim mean inflation rate. There's some early signs of goods price inflation beginning to moderate. So we think there's a good chance, and that's our forecast, that the pace of inflation will be slower through the course of this year than it has been in the last year or so. When we look at wages growth, we can also use internally generated data to help us measure wages growth. We've seen a pickup in wages growth through the December quarter. The annual rate is now 3.3%. Now that's actually the strongest wages growth since 2012, but it's pretty modest given the strength of the labour market and quite low compared to many other countries such as the US, where it's over 5%. We do expect a further increase in wages growth as the year progresses, looking for wages growth to be around 3.75%. But again, that's still relatively modest compared to the tightness of the labour market, and we're not expecting a wage price spiral, certainly not anywhere near to what we've seen in countries like the US. Now, another area of the economy that's been significantly affected by the higher interest rates is dwelling prices. They peaked in April last year, and up until February, dwelling prices are down around about 10% across the nation. Now, we expect dwelling prices to be down 15% from peak to trough in this cycle, so we're around about 2/3 of the way through the decline in dwelling prices. So we do think there's some further declines to come. We can see the pace of home loan lending, owner-occupiers, investors, first home buyers is a lot slower than it was through 2020, 2021, really on the back of those increase in interest rates. And that's particularly for fixed rate lending, where those fixed rate loans, those fixed rate interest rates were very low through the end of 2020 and 2021, and they have now increased quite significantly given the Reserve Bank monetary policy tightening. So when we think about interest rates in Australia for the Reserve Bank's made it pretty clear that they're near the end of the rate hike cycle, or certainly near pausing. So we think there's one more rate hike in this cycle that will take the cash rate to 3.85%. Our current base case is that rate hike is in April, but it's a bit of a line ball call given some of the recent data flows. So we're near the end of the rate hike cycle from the Reserve Bank. But financial conditions are going to continue to tighten throughout 2023 because of the lagged effect of the higher interest rates on variable interest rate mortgages, as well as the big pool of fixed rate mortgages that need to be refinanced through this year. So the lagged effect of those higher interest rates through 2022 and early this year, we think is going to continue to slow the housing market and continue to slow consumer spending, leading to a much more moderate growth rate this year and lower inflation. So thanks for watching this special edition of Talking Economics, and we'll see you again next month.